Welcome to week 12. I do want to cover a couple things real quickly. There was an announcement I posted after two professors from Cal State University Monterey Bay came in to talk to my face-to-face classes last week. And the announcement here is entitled Career with High Compensation and Strong Demand. That was the takeaway from the presentation, that students who major in accounting at CSUMB, they can do internships while they are at CSUMB getting their accounting degree. And in fact, not only can they, but it's required that you do an internship. And those internships pay, they said, between $22 and $39 an hour, which is not too bad. Not too bad at all, right? And they said that of all 50 accounting graduates they had last year, they all had jobs waiting for them after college. They all were able to get jobs directly after college. So that's pretty impressive. You might consider accounting as a major if you have not already chosen it, especially if you're going to be going to CSUMB. They have a really good program. And if you watch this presentation, which is linked here in the announcement, you can hear Dr. Schneider and Dr. Hua talking about the program. They are very knowledgeable. You can contact them directly if you like. I included their email addresses here in the announcement, so feel free to reach out if you're interested in learning more about accounting majors over at CSUMB. And this week we have our third video discussion. The video is about Bernie Madoff. The speaker got to interview Bernie Madoff when he was in jail. She, I think, is the only author that actually got access to him while he was in jail. Well, he still is in jail. But she wrote a biography about him and his $65 billion scam. If you don't know anything about Bernie Madoff, you will certainly learn about who he was and what he did. Even if you do know about him, you'll learn about how he was able to pull it off, how he was able to trick so many people for decades and cheat people out of $65 billion. So it's a very interesting video, so I encourage you to view that and start posting in that discussion. Your posts are due by Sunday of this week. And the sooner you start, the better, right? So we don't all just post at the last minute. Then we've got the Personal Progress Journal Extra Credit opportunity. Whether you have participated in this previously or not, you can submit a post for partial credit this week. And basically your post will just be a reflection of how things have been going for you during these last few weeks of the class. You might talk about challenges you're having, achievements you've made, anything you'd like to share about your experience in the course, and only you and I have access to it. Okay, so if you post there, I will award some credit for that next week. All right. Again, it's partial credit because full credit on this activity would have required 3 posts, and this is the third of the 3 posts. But even if you didn't post previously, go ahead and submit a post. And I think that is it. We are ready to start our exercise set for chapter 12, which is on current liabilities. Here we are. We've got 16 exercises and 5 problems, but I think they're going to go fairly quickly here. So beginning with number 1. Oh, and then, by the way, current liabilities is the topic. So we're familiar with that already, right? We know liabilities are debts, and if they're current, that means they need to be repaid within a year, right? So some of this will be review, but some of it is new. Okay, this company takes out a bank loan for $200,000 on March 1st. The loan has to be repaid with 10 equal payments. So the principal, the amount that was purchased, the amount that was borrowed, is going to be repaid in 10 payments. Each time a payment is made, then the outstanding principal balance goes down, and then by the end of the loan, the principal is completely paid off. Okay? However, that's separate from the interest. The interest rate on this loan is 8%, and that is applied to the outstanding principal. So whatever's the principal balance times 8% is the annual interest. The first thing we have to do here is figure out the interest for the first year. So at the beginning, the principal is $200,500. So we're going to multiply that by 8%. However, the loan was taken out in March, and we're calculating the interest that has accrued as of the end of December. So we're really only factoring in 10 months out of 12. So our formula here is going to be, there we go, principal of $200,500 times 8% times 10 months of interest from March to December, and then divided by 12 months in a normal year. And that brings us to 3,367. So that is our answer. We're rounding off to the nearest dollar in this exercise. Okay, so it's principal times interest times the number of months, and in this case, it's 10 months of interest, and then divided by 12. That is going to be the interest for the first year. For the second year, the interest is going to go all the way from January through December. So it'll just be a full year worth of interest. But for the first year, it's prorated. For part B, we need to compute the first principal payment. Okay, well, the principal is $200,500. And remember, it's going to be repaid in 10 equal installments. So we just divide by 10. And we see the principal payment is $20,050. Right, so every year we would pay $20,050. After 10 years, the principal is paid off. Each year we're going to pay 8% interest. And again, because the principal balance is going down, the 8% is getting multiplied by a smaller number each time. So after 10 years, the loan's completely paid off. There's no more interest and no more principal. Okay? For exercise number 2, we have to decide if each of these is a current liability, a non-current liability, meaning that it's going to take more than a year to pay it off, or neither. We'll start with cash. Cash is neither. I'll just abbreviate that with an N. And we know cash is an asset, right? So it's not a liability. Federal income tax that's payable this year would be a current liability because it's payable within a year. A long-term note payable would be a non-current liability because it's not due until next year. However, the current portion of a long-term note payable is due this year, right? The current portion and the amount that we have to pay this year is a current, is a current liability, even though the rest of the note is a non-current liability, okay? So when you have a long-term loan, the portion that's going to be paid after this year is non-current. The portion that's going to be paid this year is current. E is a note payable due in 2 years, so obviously that would be non-current liability. Interest expense is not a liability, it's an expense. So we'll put neither. If it said interest payable, that would be a liability because we need to pay it. But interest expense just means we have recorded an expense related to interest. That does not necessarily mean we have a liability. And then state income tax payable, it doesn't say payable, but that's what they meant. That would be a current liability because income taxes you typically have to pay within a year. All right. There we go. That's exercise number 2. Let's go on to number 3. Okay, in this one, we need to look at these transactions. We need to figure out how much money the company owes after all 4 transactions and what account that would show in, that liability would show in. So this company buys 30 light fixtures at $20 each. Okay, so that, I'm just going to put a note here, that is $600, right? $600. Then the company returns 10 light fixtures at $20 each. Okay, so that's going to reduce the amount they owe by $20. Then they buy an additional 15 light fixtures at $15 each. That comes out to $225. Then they pay $100 towards their debt. Okay, so we started off with a $600 account payable. It went down by $200, and it went up by $225 for the next purchase, and then down by $100 for the payment. So 600 minus 200 plus 225 minus 100. That leaves us with a $525 balance. And the account would be accounts payable. All right, we have answered exercise number 3. Let's move on to number 4. Okay, so this company received a cash payment from a customer for 40 dog dishes that cost $25 each, okay? So that means they received $1,000 from the customer, but they have not provided the dog food dishes to the customer. So they have unearned revenue. Then on April 4th, they provide those dishes to the customer. So that unearned revenue goes away with a debit, right? Because it's a liability. Liabilities increase on the credit side, decrease on the debit side. Need a little bit of water. Okay. So the unearned revenue goes away with a debit, and we can now call it revenue because we have provided the dog food dishes. So we credit revenue, okay? So we had unearned dish revenue be credited when that liability occurred that we owe the dog food dishes. Once we provide the dog food dishes, that liability goes away with a debit. And now we have revenue, which we record with a credit. Okay, that is number 4. Moving on to number 5. Here we have to fill in the account names. So this company contracts with the supplier to purchase 300 water bottles for merchandise inventory on credit. We see the credit terms over here. $10 each. Okay, so 300 times 10 is $3,000. Question is, what do we debit? Well, we bought merchandise inventory, so that is what we debit. And we didn't pay for it. And we know we didn't pay for it because we know what the credit terms are, right? If we have credit, that means we did not pay at the time of purchase. So we call that an account payable, right? Because we have to pay our supplier later. Then on April 15th, we pay off that account payable. Now, the invoice was dated April 7th. The payment was April 15th, so that's 8 days later. The credit terms were 210 net 60, right? So we would get a 2% discount if we paid in 10 days. Well, 8 days is within 10 days, right? So we do get a 2% discount. So we take the total account payable that we have just debited, multiply by 2%, that comes out to $60. That's the discount we get for paying early. And that discount, if we're doing the perpetual inventory method, which we are doing in this case, that discount reduces the cost of our merchandise inventory. So we credit merchandise inventory. Then the difference, the account payable minus the discount, is what we have to pay in cash, which we know includes checks, but it also includes online financial transactions. Like if we sent the money through PayPal or just Zelle or some direct wire transfer, anything like that would also be a reduction in cash. Okay, so there's our journal entry: debit to accounts payable, credit to merchandise inventory, and cash. And moving on to number 6. So this is an electronics store. They sell a cell phone for $450. So they can count that as a sale. However, that's a retail sale, so they have to also collect tax. Technically, they don't have to collect the tax, but they have to pay it. So they typically collect it from the customer because the company doesn't want to pay it, right? So they make the customer pay the tax. So what they would do is say to the customer, okay, you bought a $450 phone, the tax rate is 3.5%. So we'll multiply the price of the phone times the sales tax rate, and it comes out to $15.75. So that is now a sales tax payable that the company has to send in. Here in California, they would send it to the Franchise Tax Board. But for now, they just hold it. So it's a sales tax payable. And the customer has to pay the price of the product plus the sales tax, right? Then on September 6th, they make a $500 sale. I don't know where this company is that they have a 3.5% sales tax, because around here it's closer to 9%, I think. 8.5, something like that. I don't know. I don't really know. I don't pay attention. Maybe I should. But the sales tax is impacted not only by the state, but also by the county and the cities. So you might find sales taxes differ from one city to the next. But in this example, it's 3.5%. So we take the price of the cell phone times 3.5%, we get $17.50. So that is another sales tax payable. The customer in this case has to pay $517.50. And then when it's time for the company to send off the sales tax payment to the Franchise Tax Board, they can pay both at the same time. There was the $15.75 sales tax and the $17.50. Together, they come to $33.25. Okay, so that is a debit to sales tax payable because we are clearing out that sales tax payable. And it's a credit to cash because we don't have that cash anymore. All right, that is number 6. Moving on to number 7. This company takes out a $650,000 loan. They are going to pay 8.5% interest. And they're going to pay principal of $80,000 a year. So the first thing we need to do is figure out their principal balance on December 31st of the first year. Okay, well, they're going to make the principal payment that day, but we use the principal balance from before that payment is applied to figure out how much interest has accrued. In other words, the company owes $650,000 from the day they take out the loan all the way until December 31st. They're making a principal payment on December 31st, but we're still going to use $650,000 as the principal balance that we're going to calculate the interest by. Then we're going to apply their $80,000 principal payment, right? Because it wouldn't be fair to the company to say, hey, we don't owe interest on this $80,000 we just paid. Well, yeah, you do, because this interest was for the whole year that you hadn't paid any principal, okay? I hope that makes sense. So the answer to part A is 650,000. That is the principal balance before we apply the payment. And this is the principal balance we're going to use to calculate how much interest is due. Then let's calculate how much interest is due. We take 650,000. We multiply by 8.5%. That comes to 55,250. It's for an entire year. So if we wanted to, we could say times 12 divided by 12, but you probably know that that's going to get us back to the same number. So we can just skip that step when we're using a full year of interest. Okay, you can just skip the times the number of months divided by 12, and instead just take the principal times the interest rate. And then you know the interest for the year. So that's 55,250. And our journal entry is going to be the same number. For that first year, that is our interest expense. Yeah, because we borrowed the money. And if we haven't paid it yet, that is also our interest payable. Moving on to number 8. This company sells board games, and let's see, they buy some inventory for $5,000 on credit. So they got merchandise inventory. They have not paid for it. So it is a credit to accounts payable. Then on October 7th, they return $1,000 worth of merchandise. So their accounts payable goes down by $1,000 with the debit, and their merchandise inventory goes down by $1,000, which would be with the credit, right? Because that's an asset. Then they pay their remaining balance. So if they originally had an account payable balance of $5,000, then it got reduced by $1,000. So now they owe $4,000, right? So their account payable goes down. Now, when they pay it off, it goes down by $4,000. How much do they have to pay? Well, let's see, the terms were 210 net 30. So they had 10 days to pay from October 5th. And they paid on October 14th. So that means they paid within the 10-day window, and they get a 2% discount. So we take the $4,000 that they owe, multiply by 2%. That's an $80 discount. The company only has to pay the difference, $3,920. So that difference is what they pay out in cash. And the $80 discount we record as merchandise inventory because, again, it reduces the cost of the inventory. All right, let's move on to number 9. Here we first need to make an income statement, and we'll make a balance sheet. Now we have to look, there are some contingent liabilities here, and that means that there are some things that we think we might owe money for, but we don't know for sure. So for example, there is a pending lawsuit for $2,700 in damages. And it says it's considered likely to favor the plaintiff. So in other words, the person suing us is probably going to win, and we're probably going to have to pay out $2,700. So we have to include that both in our calculations on our financial statements, but we also have to include it in the notes on our financial statements. There's a second lawsuit, but that one we think the customer may win, and it's for $3,500. So on the other hand, it says that outcome is only reasonably possible. So the customer might win, but they might lose. It could go either way. So that we do not actually have to include in our calculations, but we would still include a note on the financial statements. Lastly, we have a warranty expense. We estimate that it's going to cost us $210 to provide warranty repairs or replacements to our customers. So that is another contingent liability because it's based on a estimate. I couldn't think of the word. Okay, so those are three contingent liabilities. So let's go ahead and start with the income statement. We have sales revenues of $13,700. That is our only source of revenue, so that is also our total revenues. We have cost of goods sold of $3,800 and gross profit of $9,900, right? Revenue minus cost of goods sold is gross profit. Okay, then remember, excuse me. Oh, I'm sorry, I'm sleepy. I need a nap. You probably do too. Okay, remember we had that $2,700 lawsuit we're expecting that we're going to have to pay out. So we're going to go ahead and include that in our financial statements. We also have that $210 warranty expense we're expecting. So because we can estimate those approximately, and we're fairly confident we will have expenses like that, then we go ahead and we include them. The other lawsuit that we think we might win, that one we're not going to include here, but we will include a note. We also have some salaries expense, $2,500. So let's put that in. And we can now add up our expenses. $5,410. We will subtract that from our gross profit. And we get a net income of $4,490. Okay, great. So we're done with our income statement. We can now make our balance sheet. Now the assets will be easy because they're all in a nice row here. I'm just going to copy these assets, paste them right here, and we're going to add them up. And we come up with $17,100 in assets. Now our accounts payable and salaries payable, those were provided up here in the trial balance. Hello, Jane, by the way. So let's go ahead and copy these payables. We also had the $210 warranty liability and $2,700 legal liability. All right. Next, we move on to the equity section of the balance sheet. We have some common stock. That is 1,500. And retained earnings. This company did not have any prior profits. They did not have retained earnings at the beginning of the period. So the net income from this period is the only retained earnings they have. So we'll put that in. And then we're going to go ahead and add everything together. All the liabilities plus the equity. And I get 17,100, which matches our assets. So that's good. We are in balance. Now for the last part, we need to include the notes that we will put in our financial statements regarding our contingent liabilities. So that's already kind of been written out for us. So I'm going to take this information. I'm going to paste it down here. In the last sentence, I'll move to this last section. Okay. So under legal claims, the notes we would include in our financial statements would talk about the two lawsuits, the fact that the first one of $2,700 we're probably going to lose, and the second one of $3,500 we might win, we might lose. Okay. So we've communicated that to anybody looking at our income statement or whatever financial statement we put it on. And probably would be a good idea to put it on all the financial statements. And then the warranty information that we have estimated we'll have to pay out $210 in warranty repair. Okay, so we are done with number 9. Are there any questions? Okay. All right, let's go ahead and solve number 10. So this company, let's see, they bought 6,000 dog treats at $1 each. Okay. And we see the payment terms, which tells us they bought on credit. Okay, I don't know if we'll need that, but let's highlight it with bold. And let's see, the company pays half of how much they owe on February 28th, but they cannot pay the remaining balance in 4 days. So the supplier issues a short-term note with a 6% interest rate, and it is payable in 9 months. Okay. So what we have to do is journalize these transactions. The first journal transaction is the purchase. Again, they bought 6,000 dog treats at $1 each. That is $6,000. Then they paid for half of it on February 28th. So half of the accounts payable goes away, and they only need to use half as much cash. Then the seller, when the rest of the balance isn't paid, the seller decides to convert that remaining $3,000 account payable balance to a short-term note payable. And in that case, the buyer is going to have to sign that note and agree to pay interest. The way you journalize that is you just debit the account payable, credit the short-term note payable. All right, so that's it for number 10. For number 11, we're going to use the same information and show the journal entry to record payment of the note, okay? So when we pay the note, obviously cash is going to go down. The $3,000 principal balance is going to go down, so that's going to be short-term notes payable. And the difference here is the interest. How we calculate the interest, again, we take the principal balance, the amount that's owed, times the interest rate, times 9 divided by 12. Well, 9 because when the short-term note payable was issued, it was for 9 months. So that means it has to be repaid in 9 months. Okay, so when we do that, principal times interest times number of months divided by 12, we get 135. And so that's how much interest it's going to cost us. So that is going to be interest expense. Okay, ready for 12? This company takes out a loan of $500,000. The terms of the loan are 2.9% interest. Payable in 8 months. And it says interest is due in equal payments each month, okay? So that's key. We have to calculate how much interest is due each month. And if it's equal payments, that means it's what they call simple interest. So for example, if the principal is 500,000, we can calculate what 1 month's interest is going to be, and it's going to be that same amount every month for 8 months. We're not compounding, like we're not charging interest on unpaid interest. We're also not decreasing the principal. In this case, we're just taking the $500,000, figuring out what 1 month of interest is at a 2.9% annual interest rate, and then that's the amount of interest that will get charged every month. So let's do that. $500,000 times the interest rate, 2.9%, times 1 month, because we want to know how much interest is there for 1 month, and then divided by 12, because the interest rate is based on 12 months. And we get 1,208.33. That is the interest for the first month. Okay? When they make the last payment on this loan, that's when they're going to pay off the entire amount that they borrowed. That is not typical. Usually lenders want partial principal payments throughout the period, but in this case, they're getting it all at the end. So they'll have to pay out the note payable, the final interest installment, and that comes out to a total of 1,208.33. Okay, let me take another sip of water. Now we're getting into payroll. With payroll, some deductions are voluntary by the company, some are involuntary. And what that means is if you're an employer, there are some things you have to take out of your employees' paychecks by law. It's involuntary because you have to do it. There are other things you could offer to take out of your employee's paycheck if they want you to, but you're not obligated by law to do so. These would be voluntary deductions. So we're going to classify these 8. The first is FICA, Social Security tax. We normally just call it Social Security. FICA stands for Federal Insurance Contribution Act. So it covers Social Security, which is really a type of insurance because we pay in and then, probably get that money back when we're in retirement. I say probably because, some people maybe die young and they never are able to collect their Social Security, but most people live long enough to start collecting Social Security, and some people might collect it for 40 years, from the time they retire until they do eventually pass on. It might be longer than they actually worked. So How long you collect Social Security varies. But anyways, back to accounting. Social Security tax has to be deducted from employee paychecks by law. So it is involuntary. Okay. Vacation pay is voluntary. Companies do not have to offer that. They do not have to offer 401k plans, and they do not have to agree to deduct charitable contributions from employee paychecks. They can. I can tell you here at Hartnell, I contribute to the Hartnell College Foundation, which it supports students, especially if those students are having financial struggles. And Hartnell takes that directly out of my paycheck per my request. So it's a convenience for me that they do that. And again, the money doesn't go to the college, it goes to the foundation, which then goes to the students. Okay, so that is voluntary on my part and on the employer's part. Next, we've got federal unemployment tax. That is something, it doesn't actually come out of your pay as an employee. It's something the employer pays for, but you will typically see it on your paycheck. So it's not really a deduction, but it is listed on your paycheck. So that is involuntary. It is a deduction from the profits of the company, but it's not a deduction from our compensation as employees. Health insurance is optional for most companies. There might be some exceptions, but that is a voluntary benefit. FICA Medicare tax, just like Social Security, Medicare is involuntary, and the same thing with state unemployment tax, okay? So those are the answers there. Let's move on to number 14. Okay, this company has, let's see. Oh, okay, has an employee who earned $6,000 in this month, okay? I guess there's only one employee in this company, or we're just doing payroll for that one employee. So we put the total amount that they earned as a debit to salaries expense, because that is an expense to us as a company, and it's an expense to pay the employee's salary. However, they don't get the full amount that they earned. Some of it goes towards payroll taxes, right? So as it says here, 6.2% is what goes to Social Security. So if we take that $6,000, multiply by 6.2%, $372 is going towards Social Security. So if you're, if you ever wonder where does the money go out of my paycheck, when I look at it and I see how much I earned and how much they took out, well, Social Security is 6.2%. Medicare is 1.45%. So we'll take 6,000 that the employee earned times 1.45, and that's another $87 coming out of the paycheck. In this case, they gave us the federal income tax of $400 and state of $75. They can vary, so usually there's a computer program that figures that out for you, or there are tables where you can look it up. But here they just gave us the income tax deductions. Deductions, that's not the right word. They're deductions from the paycheck. So yeah, okay, they are deductions. But when we think about tax deductions, when you file your income taxes, that's a different story. Okay, this company also offers health insurance. The employee covers 30% of that, and the premium is $200 a month. So 30% of $200 is $60 coming out of the paycheck for health insurance. Then we've got union dues, which it says are $50. So that is something that the employee, if they pay for union dues, they are paying it, but it's getting taken directly out of their paycheck by the employer. And that money doesn't go to the employer, it goes to the union. So the employer's keeping that money out of the employee's paycheck and then turning it over to the union. Okay, so now we know what all of our payables are associated with this employee, and we know why they're not going to get $6,000, which they earned. They're going to get $6,000 minus all these deductions. And that comes out to $4,956. That is what they actually get in their paycheck. Okay. So that is going to look like a debit to salaries payable. Oh, I'm sorry. This is when, no, I was missing something. This is when the employer actually pays the employee, then the salaries payable goes away with a debit and cash goes down. Okay. Moving on to 15. Okay, here we have another employee. Now we're calculating the employer's costs, because in the last exercise, those were all things that got taken out of the employee's earnings. Now we're looking at the part that the employer has to contribute. So in this case, we have, it's the same employee. They earn $6,000. The employer has to contribute 0.6% for federal unemployment tax. The employee does not contribute to unemployment. That only comes from the employer. So 0.6% for federal. State, in this case, it says is 5.4% for unemployment tax. And that money goes into a pool that the state manages, and then if the employee files for unemployment and gets approved, it gets paid out of that pool of money. Okay, then also the employer has to contribute the same amount as the employee to the Social Security and Medicare. So the employee pitches in 6.2% for Social Security. The employer pitches in 6.2% out of their own pocket. Okay, so that's Social Security and Medicare. And then, in fact, we already know those amounts. We know that Social Security was $372, Medicare was $87. So let's go ahead and fill those in. The 6,000 times 0.6% gets us our $36 federal unemployment tax payable, which, do we see one? Yeah, I'm just going to copy and paste. Federal unemployment tax payable. And then the next one, the 324, is the state unemployment tax payable. And how do we know that? Because it said the state rate was 5.4%, right? So if we take the $6,000 that the employee earned times 5.4%, it's $324. Okay, so these are the costs of payroll that the employer has to pay, and we are going to call it payroll taxes. No, I don't remember what it's called. Let's find it. A15. Oh, come on, it's in there. Sometimes my search doesn't work. I don't know why. EA. Oh, there we go. We need one more. There we go. 15. Oh, we're on 15. Okay. Employer payroll taxes expense. That's what it's called. Okay. There we go. Employer payroll taxes expense. All right, so that is part A. Oh, then we also have $140. That 140 is the employer's 70% of the health insurance benefits. So remember, the employee had to pay 30% and the employer has to pay the other 70%. So that is a credit to health insurance payable and debit to employee benefits expense, I think. Whoops, no, wrong document. Benefits expense. Benefits, try that again. Expense. Okay. So that was $200 for health insurance premium times the 70% that the employer has to pay. Now, the reason it's separated out here is the health insurance premium gets paid someplace different. The payroll taxes might all be able to be paid to one place, and then they distribute it out to state and federal. Okay. Now, part B here. Oh, part B is when we actually send the payments off. So we might recognize some of these. 36 and 324, those were the federal and state unemployment taxes, right? So now those are getting paid. So they get debited. The 475, you might remember we withheld from the employee's paycheck. Those were their federal and state income taxes. Again, those are getting debited because they got paid off. And the other two, you probably don't recognize these numbers because we have not seen them before. But what they are the Social Security from the employee and from the employer together, right? Because we contributed 372, we also withheld 372 from the employee. Together, that is 744. So we are debiting Social Security taxes, and the 174 for Medicare, again, is the employer's portion plus the employee's portion that we withheld from their paycheck. And together we'll send that off, it'll be 174. So when we pay these all off, cash goes down, right? And the final one here is the union dues that we had to pay. So union dues payable goes away with a debit. Oh, actually, there's one more. I forgot, we have to pay the health insurance. Okay, so the health insurance payable goes away with a debit. Okay, so now we processed first the employee's paycheck, right? This was exercise 14. Then in 15, we figured out how much we have to pay for the payroll taxes and how much we have to pay for the health insurance. And then for part B of 15, here's where we actually paid it. We sent in the money for payroll taxes, both from us as a company and what we withheld from the employee. We sent the union dues off to the union, and we sent the health insurance payment off to the health insurance company. Okay? So we're done with 15. Jane, if you have any questions, let me know. Otherwise, we'll move on to our final exercise here. And in this, and then we've got some problems to go over. In this one, it says the employee covers 35% of their pension plan, and the pension plan contribution is $900. The employee contributes 25% of their health insurance premium, and that is $375. Okay, so first thing we have to do here is figure out how much the employee needs to contribute for both. So the pension plan, again, was $900, and they pay 35% of it. That's $315. Then the health insurance of $375 times 25% is $93.75. Let's add that to the $315. And the total employee contribution is $408.75. Okay. Make sure my math is right on that again. 408.75. Good. Then the employer has to pay the rest. So the employer is going to pay 65% of the pension. That's $585. They are going to pay 75% of the health insurance, right? Because that's the portion that the employee didn't pay. That's $281.25. So we can add those together and get the total benefit expense, $866.25. And we can confirm that that matches $866.25. Okay. So we're done with the exercises. Now we'll move on to the problems. And let's open up the problem set so we can do that. All right. Starting with number 1. Okay. We've got 4 situations, and each one we have to figure out what account we would use to record the liability and what would be the amount. In the first example, company buys $10,000 worth of equipment on credit. So the liability is $10,000, right? And the account would be accounts payable. Okay. The second one, a customer buys a watering hose for $25. Sales tax is 5%. So the liability is the company now has a sales tax payable because they collected the sales tax from the customer, and the company now has to send it in. I believe they send it here in California to the Franchise Tax Board. So we are going to take the $25 cost of the item times the 5% tax rate that we were given. That's $1.25. So that is the amount of the liability, $1.25. Okay. For C, we've got customers buying tickets for soccer. There are 14 customers, $250 per ticket, and each one buys 2 season tickets. So $250 times 14 customers times 2 tickets each. That's $7,000. So that's the amount of the liability. The type of liability is unearned revenue because the customer has paid, but they haven't been able to see the soccer games yet, right? Once each soccer game is played, then a little bit of that unearned revenue goes away and becomes revenue. The last example, company issues 2,000 shares of common stock. It's not a liability. So I'm just going to put NA and NA. Not applicable. They were trying to trick us. Next, we'll do problem 4. All right, so we're doing some journal entries here. Okay. 4 transactions. The first one, the company receives advance payment from a customer for landscaping services, $3,500. Okay, so they received cash and they have unearned landscaping revenue. Okay. You could just put unearned revenue, but I believe, and I'll double check it here, but I believe the textbook called it unearned landscaping revenue. Again, that does not work today. So let's do it this way. Problem number. Yes, unearned landscaping revenue. Okay. Then on December 11th, they provide the landscaping services. So that unearned landscaping revenue goes away with a debit. And in its place, we credit landscaping revenue, right? Because now we've earned it. Then on December 14th, another customer pays $4,400 worth for landscaping services. So again, we have some unearned landscaping revenue. Then on January 19th, we provide 80% of the services. So we did most of the work, but not all of it. So what we do, it was $4,400 that the customer paid. Multiply that by 80%. So we've done $3,520 worth of work. So that unearned revenue goes away. And in its place, we've earned $3,520 of landscaping revenue. And then we'll go back sometime and do the other 20%, and then we could journalize the rest of the revenue. Okay. Next will be numbers 6 and 7. Okay, here's where we're getting into contingent liabilities. In this case, we need to look at each of 4 different situations and first determine what is the treatment. In other words, are we going to treat it as probable and estimable that we're going to have to make this payment? Probable and inestimable, meaning we are probably going to owe something here, but we have no way of knowing how much. Reasonably possible, we might owe money, but we might not. It could go either way. And remote means there's a chance, but we probably are not going to owe any money. Okay, so it's only a remote chance that we will have to pay. So we're going to pick one of those 4 categories for each of these 4 situations. If the answer is probable and estimable, we'll have to journalize it, and those numbers are going to end up on our financial statements. We also are going to have to include a note on our financial statements explaining this contingent liability, because remember, it's not 100% for sure. So we have to include a note that explains it. If the answer is probable and inestimable, then we still include a note on the financial statements, but we do not journalize it. which means it does not show up numerically on our financial statements, only as a note. Same thing if the answer is reasonably possible that we're going to have to pay this debt. In that case, also, we include it as a note, but we do not journalize it. And lastly, if it's only a remote chance we're going to have to pay, then we don't journalize it and we don't include it as a note on the financial statements, okay? So the treatment is going to dictate how we then recognize, meaning record it in our journal, or disclose, record it as a note in the financial statements, each of these transactions. Okay, so the first one, A, it says it's a pending lawsuit, $100,000 in damages. It is considered likely to favor the plaintiff. That means we are probably going to lose because we would be the defendant and the plaintiff is probably going to win. So we are going to treat this as probable and estimable because we're probably going to lose and we can estimate how much it's going to cost us. The requirement is recognition and note disclosure. So we are going to both recognize it in our financial statements numerically, and we are going to disclose it in a note in the financial statements. And this is what the journal entry is going to look like. $100,000 of legal expense based on our estimate, and $100,000 of estimated legal liability. Now, if it turns out to be more or less than 100,000, then we can make an adjustment later. Okay, so that's how we do A. B says there might be other potential lawsuits, but that is unlikely to occur. So that is remote, right? That is a remote treatment. There's only a small chance that we are going to have to pay out for these other lawsuits. So in that case, there is no recognition or disclosure. Okay, since it's remote. C says, let's see, we've been sued for a dishonored service contract. The plaintiff will likely win. Okay, so it's probable that we're going to have to pay something, but the damages cannot be reasonably estimated. So that would make it probable and inestimable. And the treatment on that, again, means, means we do need a note disclosure, but no recognition. We do not have to journalize it, and it will not show up numerically on our financial statements. The last example says a customer will win a lawsuit if filed. Oh, we believe a customer will win, but the outcome is not likely and not remote. So why do we believe the customer is going to win? I don't know. But if it's not likely and it's not remote, that means it's like a close to a 50-50 chance. So maybe we think, 60% likely they're going to win, 40% we're going to win. So it's not really, that clear. So we're going to treat this as reasonably possible. Reasonably possible. Okay. And again, if it's reasonably possible, we do need a note. Sorry, we do need a note, but we do not need to journalize it. So I'm going to put note disclosure, but no recognition. Okay, those are the answers for 6. Let's go on to 7. Okay, so this company provides pool cleaning and maintenance services. Let's see. we need to journalize the transactions. So 15 pools under Part A at $550 each. Warranty estimates are 2% of sales. So in other words, the cost to us to provide warranty repairs and replacements to our customers, well, you can't replace a pool, really, can you? You could repair it. But the warranty costs generally come out to 2% of our sales. So that's what we're going to use for our estimate. So for A, 15 pools times $550 each is $8,250 of revenue. 2% of that is 165. Okay, yes, sorry. So 165 is the warranty expense that we are estimating, and the warranty liability, again, it might be wrong, so we will perhaps have to adjust it later. Okay, and then the 15 pools times the $550 each, that was $8,250 we received from our clients, and that was $8,250 of sales. Okay, so this is what our journal entry looks like to record that month's worth of cash sales and estimated warranty costs. Part B says, a customer filed a warranty claim with us and we honored it. So now our warranty liability that we had estimated of 165, it's gone down by $100 because that's actual warranty cost. So it's no longer a liability. And we paid out cash, so cash is going down with a credit. C says another customer files a warranty claim, but we don't honor it. We say, sorry, you didn't do your end of the bargain. So because you didn't take care of your pool, the warranty has been invalidated. We do not have to pay you anything. So that is why no journal entry is needed. So there was no cost because we did not honor. And the last one, somebody files a lawsuit regarding the dishonored loyalty for $1,500. So that person that wanted us to cover them under warranty, and we said no, they sued us for $1,500. We determined that the lawsuit is likely to end in the plaintiff's favor. So in other words, we're probably going to lose. So we're going to have to go ahead and count that legal expense. So we journalize it and the legal liability. Okay. So that's what the journal entry looks like for that. And again, it would also show up on the financial statements as a note. And our last problem is problem number 10. Here we go. Okay, this is another payroll situation. We have 3 employees who earned bonuses. So we are going to pay out their bonuses, which combined come to $23,000. We have to take out the Social Security, which is 6.2%. That's $1,426. We have to take out the Medicare, so 23,000 times 0.0145, $333.50. We have to take out the federal income tax. They provided us with those numbers, so we didn't have to calculate them. That looks like $2,681. State income tax, it says here is 5%, so that's not, necessarily the case always, but in this example, we'll take the 23,000 times the 5%, we get 1,150. 401k contributions are 2% of gross pay. So we'll take the 23,000 times the 2%. That's 460. Okay. And the difference is what actually gets paid out to the employees. So we're going to take the $23,000 that they earned minus all the deductions and we end up with $16,949.50 that we have to actually pay out to the employees. Let's see. I'll just go down. Okay, $16,949.50. There we go. All right, we are done with the problems that we're going to go through together. So good luck on that. If anyone's going to the Arts Outreach Conference, that's this Friday. Hope to see you there. If there are no questions, we are done for today. All right, so see you later.